Hello, I'm Pat O'Hare, Chief Marketing Analyst for Briefing.com. Today is Monday, October 6th, and in his latest Big Picture installment, Briefing.com CEO Dick Green discusses the economic outlook. In his piece, Dick writes, "Confidence is important in the credit markets. It is also important to the economy. In this regard, the past 2 weeks have been a disaster for the economic outlook." Amid all the negotiations surrounding the financial relief plan, there were 2 weeks of non-stop statements that the economy is on the verge of collapse unless the plan passed. Whether this was true or not will never be known. There are no controls against which to compare the real-world experiment in the world of economics. What is known is that the level of concern about the economy has increased dramatically. This is different from the nearly worthless consumer sentiment surveys, which simply reflect swings in gas prices and political developments. Now there is far greater underlying concern about the future on the part of consumers and worse on the part of businesses. The associated restraint in spending will have an economic impact in the fourth quarter and beyond. It is possible that the stock market will turn higher and help develop confidence that the plan will work and that the mood improves. However, at this point, the impact from the debate over the plan is strongly negative. Our forecast for third quarter real GDP has been lowered to 1%. This is higher than most forecasts, primarily because our forecast incorporates a larger gain from inventories than most acknowledge. As this proves the case, the inventory impact will undoubtedly be quickly dismissed by economists and the press, which would be in stark contrast to the analysis of the second quarter when the negative inventory impact was ignored. There is no denying, however, that consumer spending has hit a wall. It will be near flat in the third quarter. More importantly, in our opinion, business investment trends are slowing. The impact won't be severe in the third quarter data because it takes a while for the quarterly averages to move. And holding up the GDP number will again be the net export category. It should add over 1% to the annual GDP gain. In any case, the third quarter is now over. The real GDP number will post a modest gain at best. The greater concern is the fourth quarter. Consumer spending trends are clearly sluggish, and at this point it is difficult to determine whether the traditional relationships with payrolls and income will hold. There is a real risk that the national obsession over the economic crisis will put a strong check on consumer trends. It is a common mistake to underestimate the U.S. consumer, but there are other concerns as well. Many economists welcome the recent strength in the dollar. We do not. The stronger dollar over the next few quarters will eliminate the strong boost to the economy from the export boom of the past couple of years, as well as the decline in imports that has helped U.S. producers. The net exports component of GDP has boosted the reported real GDP numbers by an average of 1.9% since the first quarter of 2007. That boost will fade away over the next few quarters. Housing may actually stabilize, but there will be no engine for economic growth until consumer spending gets back on track, and that may be a while. Fourth quarter real GDP is likely to be very sluggish. It may even be negative, or it may post modest growth. Either way, economic conditions will not be good. We have long argued that the pessimism over the economic trends is overdone, and that is still true. When the story of this economic cycle is written, the real GDP changes will look surprisingly strong relative to other cycles. Similarly, this credit crisis will be seen as a Wall Street phenomenon more than a classic credit crunch. Nevertheless, the economic outlook is not encouraging. The U.S. is facing a period of sluggish economic growth. That view, by the way, has been a staple of our long-term forecast. The fact that the U.S. economy is proving amazingly resilient in the face of extreme difficulties should perhaps be the real story, but it is not. The negative tone is overwhelming, and it is not about to change. The implications for the stock market are not clear. The stabilization in economic expectations in the stock market could alter the focus to the reality that, barring a total economic collapse, stocks are extremely cheap. For now, however, the near-panic conditions in the financial markets and the incessant talk of an economic crisis will lead to lower economic growth than would have occurred if the Pulse and Rescue Plan had been immediately approved as presented. In brief, the economic outlook has worsened. To read Dick's article in its entirety, put your cursor on the Our View tab at the top of the page and select the big picture, which is the fourth page listed on the drop-down menu. I'm Pat O'Hare for Dick Green and Briefing.com. Thanks for listening.